This is Perspectives, a bi-weekly investment podcast brought to you by Escala Partners. In a world cluttered with information, Perspectives cuts through the noise to bring you insights and commentary on global financial markets, economics, and geopolitical news and events.
Welcome to Escala Partners Investment Perspectives. And of course, welcome to Liberation Day today. In less than 3 months since President Trump began his second term, so much has changed. And these changes are reshaping government policy globally, trade, and the outlook. So today we'll be focusing our discussion on 3 key topics. We'll discuss the historic shift in German fiscal policy. We'll take a closer look at how US companies and sectors are being impacted by the trade war. And finally, we'll discuss our most recent investment decision. And as usual, I'm joined by our Chief Investment Officer, Tracey McNaughton. Welcome, Tracey.
Hi, Ed.
So Tracey, let's jump right in. Tracey, for decades, Germany has been the poster child of fiscal conservatism in Europe. The country's approach was shaped by its post-World War II economic memory, where inflation and debt were deeply stigmatized. The past few weeks has seen a seismic shift in that view.
Exactly, Ed. It has been a very big couple of weeks. On March 14, Germany's new Chancellor in waiting, Friedrich Merz, reached an agreement with the Green Party that will allow Germany now to increase spending on defence and infrastructure projects. And so, as you say, the agreement upends decades of German fiscal conservatism.
Yeah, it was a historic shift in Germany's fiscal policy.
Yeah, it really was. Our friends at Deutsche Bank likened it to the fall of the Berlin Wall in terms of its significance. Germany has had this constitutionally enshrined debt brake in place since the GFC, since the global financial crisis. It was designed to limit government borrowing because there were concerns spending after the GFC would get out of control and lead to the much feared inflation. That meant that German defence spending was limited to less than 1% of GDP. The Merz agreement doesn't entirely eliminate the debt brake itself, but instead what it does do is it carves out exceptions for defence and infrastructure spending.
Still, it means some significant government spending in Germany. What does it say about NATO?
Well, it signifies Germany's shift toward taking greater responsibility for European security, particularly now that the US is reining in some of its spending. Germany is moving to fulfill its NATO obligations, which for so long it's been under those obligations. It's not the only NATO member to be doing this either. Sweden is planning the largest military build-up since the Cold War. Denmark, Poland, Latvia, Estonia, Belgium, even Spain have all announced a significant increase in defence spending in the past month or so. I suppose, not surprisingly, the countries most focused on increasing defence spending are the Eastern European countries, those that are closest to Russia.
So Tracey, is this another Cold War?
Well, Cold War 2.0 is a phrase increasingly used by analysts and some politicians. Whatever you want to call it, defence spending around the world is definitely increasing quite significantly. This is being reflected in the performance of defence stocks. And we've also noticed it, Ed, with our fund managers. There has been a rise in allocations to defence stocks within the portfolios that we oversee.
So Tracey, domestically, the Australian government brought down its budget last week. Did defence spending get a boost here?
Not really. The defence budget has increased from 2.03% of GDP to 2.05% in this budget. As our discussion with Fidelity's geopolitical analyst and former CIA agent noted with us last week, we are an island nation in an increasingly contested region. at a time when the US is redefining its role as the global defender of democracy. So defense deserves more focus, but it's not the kind of issue, unfortunately, that politicians see as a vote winner ahead of the election.
So Tracey, let's turn to trade policy and specifically tariffs. Today is Liberation Day, as I mentioned earlier, the day the Trump administration is expected to announce the most aggressive pivot in US trade policy in decades. There's been a lot of headline noise, but break it down for us. How are US companies actually being affected on the ground?
Tariffs are hitting across multiple sectors, Ed. The biggest shift since March 2025 has been the White House's decision to impose broad-based tariffs, most notably the 25% blanket tariff on all imported vehicles and parts. This is a big move, especially for automakers and parts suppliers and downstream businesses like dealerships and repair services.
Yeah, that's massive. So what are companies doing in response?
Well, US automakers like Ford and GM benefit somewhat because foreign competitors like Toyota, BMW, and Hyundai now face higher costs to sell into the US. But many American branded cars are built using a lot of globally sourced products. So, for example, a Ford F-150, that's a popular US assembled vehicle, it sources 55% of its parts from outside of the US. So it might be assembled in Michigan, but have transmissions or electronics from Mexico, China, or Germany. And so a 25% tariff on those parts directly inflates manufacturing costs. Automakers can then either eat those costs and hurt their margins, or they can pass them on to consumers and then risk lower sales volumes. A quote from an American auto parts supplier says it all, I think. He said, "There were 3 changes in 24 hours affecting us as a North American auto supplier, and that's a little bit disconcerting. We can't guess what or how or who at the moment. It's like a whipsaw." So this is the experience that some of these manufacturers are facing. Having to make business decisions in this environment is near impossible.
So even made in America isn't immune. The idea of a 100% made in America car doesn't exist.
Exactly. It's all about the supply chain now. There's no such thing as a 100% domestically made car anymore. Leaders from the auto industry were among the first to voice concerns about this. Ford said the tariffs will create costs and chaos. And General Motors said it is considering supply chain tweaks to help soften the blow. The semiconductor space also is feeling the heat too, though. Companies like Intel and NVIDIA are caught in a bind. The Smiths Group, a British engineering firm, recently announced it's moving production of its chip testing equipment from China to Texas. So that's a clear response to the new tariffs on high-tech components and capital equipment. But that reshoring effort isn't cheap. Setting up new facilities, finding and training labour, passing environmental and various other government and regulatory approvals, it all takes time. And during that ramp up, they're still paying tariffs on any remaining imports from Asia. In addition, the R&D cycles, the research and development cycles are slowing because companies now have to divert capital from innovation to logistics and relocation costs.
And so, Tracey, what about everyday consumer brands?
Well, yeah, retailers and consumer goods companies are seeing margin compression. Tariffs on textiles, plastics, and packaging materials are making it more expensive to deliver products at scale. For instance, brands like Nike or Walmart, which rely heavily on global sourcing, are accelerating their shift to Southeast Asia, especially into Vietnam and Indonesia. The problem with this is that these regions are reaching capacity. Shipping times are up, logistics are strained. They don't have the port capacity that, say, Shanghai does. And so costs are rising.
So inflation is coming back through the trade channel.
Yeah, absolutely. The tariffs are inflationary. There's no question. And we're hearing from executives from Target and Best Buy and Mattel and Hasbro, Walmart and Costco. They're all warning consumers that price hikes are likely.
And so, Tracey, what about smaller companies? How is all of this affecting them?
Well, I think smaller companies in particular are feeling the pressure. They just can't negotiate better freight terms because of their size. They can't absorb the price hikes like the big players can. They don't have the leverage to be able to diversify quickly. And the other thing is that smaller companies do tend to have much thinner margins. And so they will have more trouble absorbing these higher tariff-related costs. Many also rely on single country sourcing relationships. So when tariffs go up overnight, their business models are really challenged. We're already seeing early signs of job cuts in niche manufacturing and boutique consumer goods companies. Some are trying to move supply to Mexico or even to the US, but they're facing long lead times, labor shortages, and higher overhead costs. We're now starting to see small business capital spending plans fall quite sharply.
And so, what are the smart companies doing right now?
Well, really, there is only three things that they can do, or one of three things that they can do. They can diversify the supply chains, as we've been talking about. Companies are moving to build in redundancy. If China is hit, they want fallback or alternative options in India, Vietnam, or even in Eastern Europe. And a lot of consumer brands are doing this, but it is getting hard though. And the recent US pressure on Mexico to levy tariffs on Chinese imports suggests that it's going to get even harder. The other thing they can do is selectively invest into the US. We've seen a lot of semiconductor companies already do this, TSMC, Samsung, SK Hynix. They're all investing in chip plants in Arizona, Texas, and Indiana. But we've been talking about this for a while. This was happening before Trump. More broadly, though, as we've just said, it is costly to reshore. So we're likely to see CapEx budgets be diverted to infrastructure away from R&D. That's not good for productivity. A third option, and this is only specific to some industries, but it could help the auto industry. It could retool factories to support defense manufacturing. And this is something that is being discussed, particularly in Germany, where car makers there are struggling with chronic overcapacity. So they're talking about retooling, but even there, that will take some time to take effect.
That's a pretty tough landscape. But I guess on the flip side, are there sectors that are less affected by these tariffs, maybe even thriving?
Yes, and that is a really important point to make, Ed. Some sectors are much more insulated. Financial services, for instance, face very limited direct exposure to tariffs. They're not importing goods. Their product is capital, credit, and advisory services, none of which cross customs lines. So if you are thinking what countries have equity markets that have a higher weight to financials, it would be places like Greece. You talk about concentration in equity markets. The Greek equity index is 55% financials. And you may shudder to think about investing in a Greek bank after the Greek debt crisis 15 years or so ago, but they have improved significantly. And even some of our fund managers are talking about increasing allocations to Greek banks. Other places that are high in financials are Singapore, Hong Kong, Ireland, and also Australia. We have an equity market here that has a high weight to financials.
And so, what are some other examples of more resilient sectors?
Well, defensive sectors in general would be more resilient. So utilities. They are domestic focused. They are regulated. Utility companies aren't directly affected by global trade frictions. Their capex costs might increase if steel or parts for grids are impacted, but revenue models are stable and relatively insulated from inflation. The other area I would say is real assets, generally, like real estate, and more broadly infrastructure would be relatively insulated as well, though again, they would also face higher construction costs.
So it's the defensive sectors plus financials and real estate that will likely be the most insulated, at least in a relative sense. And the countries whose equity indexes are highest in these sectors are the UK, Europe, and Australia.
Exactly.
So, Tracey, that brings us to an important decision that came out of our investment committee meeting last week. You've announced the closure of your overweight position in US equities relative to Australian equities. Can you walk us through this decision?
Sure. Initially, we held this overweight position based on the expectation that DeepSeek, the Chinese large language model that was released on January 27th, would democratize AI technology, allowing the broader economy to benefit beyond just the technology sector. The US market was perfectly placed to benefit from this democratization because of what we felt was a business-friendly government and expectations of much lower interest rates.
That sounds logical. So what's changed?
Well, the environment has fundamentally changed, primarily due to escalating trade policies under President Trump. We no longer believe the US government is as business-friendly as initially anticipated. We still expect deregulation to be supportive when it arrives, but a lot of damage is being done in the meantime. So we're seeing it in the data now. Consumer confidence is down sharply. Retail spending is at its lowest since 2009 outside of COVID. Consumer inflation expectations are the highest since 1993. And business is tightening up on their capex plans, and financial conditions have tightened as well.
And of course, tariff-induced inflation pressures may prevent the US Federal Reserve cutting interest rates as much as expected, further undermining the case for US equities.
Exactly right, Ed. So we decided to close the trade and book a small profit. So overall, we're no longer overweight US equities.
Tracey, it's clear we're navigating a period of substantial global change. What advice would you give to investors right now?
Well, as always, the key here is being considered and thoughtful and methodical. I was talking to someone recently who asked me a question. He said, "You talk to a lot of fund managers every day. What is the most important thing you look for in a good investor?" And without question, the most important thing we look for is process. Process does so many things for you and is particularly useful during times like now. It ensures nothing falls between the cracks. It ensures you only focus on the data and information that matter and exclude the noise. It ensures repeatability of performance. And finally, and most importantly right now, process gives you the space to think slowly and act quickly.
Good advice, Tracey. And that's all we have time for this week. I hope everyone enjoyed the update today, and we look forward to you joining us in a fortnight. In the meantime, please take care and stay safe. Thank you.
Thank you for listening to Escala Partners Perspectives podcast. Be sure to subscribe to this podcast on iTunes. You can connect with Tracey by visiting escalapartners.com.au. Escala Partners is a corporate authorized representative of Escala Wealth Management, which holds its own AFSL. This podcast has been prepared without consideration of specific client investment objectives, financial situation, or needs, and is for general information purposes only. Please don't rely on it for the purpose of making an investment decision. You should seek independent financial and taxation advice prior to making any investment decisions in relation to any of the content considered in the podcast and consider any relevant disclosure documents. If you require any further information regarding the matters discussed on the podcast, please contact Escala Partners.